All the banks, just reported earnings. They all talked about how resilient the consumer was. Credit card spend is still growing, 5, 6, 7% year over year. So
claims numbers this morning look good.
Showed a very strong jobs, number. So I agree with Jeff. The consumer remains resilient, and the credit quality data, you're seeing declines in delinquencies on cards at my bank. So I will say, and I wrote this about a week and a half ago in a piece. This credit cycle, every credit cycle is different, and sometimes it's led by the consumer, sometimes it's led by the corporate market. This next credit cycle, whenever it happens, and I think it's going to start showing up in the second half of this year, is going to be led by corporates, not by consumer. And the only way the consumer is really going to be forced to pull back is we get a significant correction in equities, which we may get. I must say my bias is that we will get. But that wealth effect from equities and securities has been just dramatic in terms of what it's done to the spending at the high end. So I wouldn't expect any pullback until we get some significant correction in the markets.
Is that a leverage issue, Charlie, or just
very much so? So last week the margin debt for the month of June came out, and as a percentage of GDP, it's at a record high. But more importantly, the rate of change over the last 3 months, the 3-month rate of change was up 23% in margin debt as a percentage of GDP. We have only seen that twice in history. Once was 2 months before the tech bubble burst around the dot-com period, and the other was 4 months before the peak in 2007 in the great financial crisis. So it's kind of supporting my thesis that we're going to have some kind of significant equity deleveraging event before year end.
Okay.
So we'll see.
It could cause the consumer to at least slow down a little bit. I know everybody's been calling for the death of the consumer for 2 years, Jeff, and Jeff's been saying no, the consumer's just fine.
That would do it. That would absolutely do it. Charlie and I aren't disagreeing. There's an absolute wealth effect driver to this. It is, when you see rounds of golf up, when you see stocks like Callaway doing well, they're just, people will fight you on this, which is what's so weird. There's all the data Charlie's pointing to. There's all the 8 kind of company-specific stuff I'm pointing to, and people will still say everyone's a moron. They're spending on credit cards that they can't afford, blah blah blah. It's the wealth effect. Everyone's kind of, we're back to a gentleman farmers kind of investing in things and playing golf all day type of economy, or at least there's whispers of it out there. I'm not sure how eminent it is, but that is, you can't just dismiss that as an idea.
And anticipating the demise of the consumer has been a bad trade, so I'm with you.
Yeah, for sure.
Wait until it happens.
Let's
see a break when it happens. When this is a trade that you don't need to catch, there's plenty of time. You don't
need to catch the top.
No, you do not.
The other thing I was just going to say, Steve, because you start off the show on Google and Tesla, I think their declines today is all related to the fact that they're negative cash flow. I mean, this is the first time that Google's gone negative cash flow. So the CapEx spending continues to outstrip expectations, and I think the market doesn't like that.
And their P&L looked a little suspect. I saw some notes about the SpaceX gains and how
$100 billion of investment gains. And that's what you saw in my big bank. So if you look at the Goldman Sachs, the Wells Fargo's, venture capital gains were a huge part of their beat and raise quarters. And again, this is all tied to the markets. I mean, it's all one big trade, as Jeff said. If markets turn, none of this revenue is going to be there in the future.
They got an Anthropic IPO to get off and OpenAI IPO to get off. You think they could hold it together until they get those out?